When you look at what the Swiss National Bank did this morning, when you try and figure out what the Bank of England is going to do later today, I mean, that's what the market's moving on right now. Is it a big concern just to think about central banks starting to soak up liquidity everywhere?
Absolutely. And I think what we've been seeing for the past week is that central banks still have the ability to surprise us by being more hawkish than expected. You saw that starting about a week ago with the ECB, then the Fed, now the Swiss National Bank, perhaps the Bank of England as well in a little bit. So we're still in this environment where interest rates are moving higher than expected. And really the fight is about bringing down inflation. And what we heard yesterday from the Fed was really important. They signaled that they're a lot more willing now to over-tighten than under-tighten, and they're willing to be backward-looking on economic data in order to realize when they've over-tightened. So all of this, the Fed, these other decisions by central banks, really increase the odds of a recession happening by the end of this year or early next year. So this risk-off reaction in the market this morning actually makes a lot more sense than the knee-jerk positive reaction yesterday after the Fed meeting. There's a lot of risk still there.
Although this is such a fickle market, you watch the twists and turns with this. If they don't do enough, if the central banks don't do enough, the market complains, oh, no, inflation is going to get out of control. If they do a lot, the market complains, oh, no, the market's going to crash. And maybe that's not fickle. Maybe that's just the reality that there are no good options here. And the only way is down by bringing down the economy, bringing down demand.
Exactly. There are no good options. Either you have inflation risk or you have economic risk. And we're trying to juggle the two. Policymakers are and investors. And I think when you think about portfolios, you have to make sure that there are enough assets to protect you against both sides of the risk. In terms of inflation risk, we're taking a look at asset classes we haven't in over a decade, especially things around real assets, so commodities and commodity-producing companies and countries. We're taking a look at things like real estate, whether REITs or physical real estate. And we're also taking a look at infrastructure, both infrastructure equities and funds. For the recession risk, though, I think that's where we're feeling a lot more comfortable adding duration, adding core quality fixed income. Now that we have the 10-year near 3.5%, I think you're much closer to the top of a range. And if anything, yields are likely to be lower by the end of the year next year as you start seeing those recession odds increase even further. So you've got to have both, but it's certainly not an easy environment for investing. And there are ways to monetize that volatility through covered calls, through investing in macro strategies, and through having very flexible tactical asset allocation to help us get to our clients' goals, which haven't changed, even though the environment certainly has.
Shepard Smith here. Thanks for watching CNBC on YouTube.